Hey everyone, and welcome back to my channel. Today we're going to talk about some good news for both new home buyers and existing homeowners. Now, mortgage rates have been dropping, and this is because of a couple things. Last week, the Bank of Canada cut interest rates, and this means that the interest rate you pay on a variable rate mortgage will be lower. Also, bond yields, which influence the fixed rate mortgages, have also been coming down. Now let's pause here and unpack what bond yields are and why they actually matter when it comes to interest rates. Imagine bond yields as loans you give to the government. In return, the government promises to pay you back with interest over time. This interest rate is called the coupon rate, but bonds can also be bought and sold in the open market, just like stocks. So the price of bonds can fluctuate depending on the supply and demand. Now here's the key. When interest rates in general go down, like what happened with the Bank of Canada cut, investors become less interested in new bonds with lower coupon rates. This means there's more demand for existing bonds, which drives the prices up. Remember, bond prices and yields have an inverse relationship. As the price of bonds go up, it's the yield that actually goes down. So how does this affect fixed rate mortgages? Well, banks use government bonds as a reference point when setting their fixed rate mortgage costs. So since the bonds are becoming more expensive and the yields are dropping, the banks can offer lower fixed rates to stay competitive. It's like a domino effect. Lower interest rates equal lower bond yields, which equal lower fixed rate mortgages. Let's add an analogy and think of bond yields as rent you can charge on an apartment. If everyone else starts lowering their rent, interest rates go down. Now, you might need to do the same to keep your tenant investors happy. That's essentially what happens with bond prices and mortgage rates. Because of this, mortgage lenders have lowered their fixed rates by up to 0.25, and the good news is the rates have gone down all across the board no matter what term you choose for your mortgage, but especially on 3 to 5 year terms. Experts are saying that rates are likely to keep going down as long as the economy keeps weakening. Now, however, there is exceptions. The big banks, while most other lenders have lowered their rates, the big banks have not, and they haven't really budged too much. Experts are saying this is because they're waiting to see if the rate cuts are a temporary thing or if it's something that's here to stay. So what does this mean for you if you're thinking about getting into a mortgage? Well, experts say that rates are likely to keep going down, but it won't be a straight shot. There will be ups and downs, and when you're choosing your mortgage, the lowest rate you can get right now is about a 4.59 for a 5-year fix. But if you're worried about locking yourself into a long term at the time when rates are likely to go down still, consider a shorter term fixed rate mortgage. A 3-year fixed mortgage is a good option right now, and you can also get a rate as low as about 4.84 with one of those. There are also variable rate mortgages that people are starting to choose again. And the reason why is with a variable rate mortgage, your rate actually changes over time, which it is quite a bit higher right now than the fixed rates, but it might be the safer bet in the future. And there's also an interesting twist to consider with the variable rates, and that's the fact that you're allowed to lock in your variable rate mortgage to the current fixed rates at any point in time. So even if your variable rate right now is about 6.25, if fixed rates in a year from now drop to about 4%, you could literally lock in all the way from 6% down to that 4% rate and be in that 4% rate fixed. So there is some flexibility in choosing the variable rate mortgage right now, and it's something that you should definitely consider as well. I don't really recommend taking anything longer than a 3-year term for a fixed rate, especially with rates coming down, because the penalty to get out of those mortgages early is quite substantial. And I'll put a link to another video right here where you can check out different prepayment penalties based on different mortgage structures. No matter which option you choose, be sure to shop around and compare the rates at different lenders to find the best deal. Now that's exactly what I'm here for as a mortgage broker. I'm a mortgage broker in BC, Canada, and we have access to 50 plus lenders where we can basically shop around and find you the best deal. We can also educate you on what you're actually getting. So if you're interested in getting a mortgage, whether that's for a renewal, a new purchase, click the link in the description. There'll be a form to fill out where you can book a call. Aside from that, please hit that subscribe button, like this video, and ring the bell to be notified. I'd really appreciate it. It helps videos just like these get out in front of more people just like yourself. Thanks a lot for watching, guys. Catch you on the next one.